We are going to start today the study session for 8. That is only the last unit left with us, and the study session 10. These two units are combined. One is the ratio analysis interpretation and the other is its application. Broadly, we are going to discuss financial analysis technique, financial statement analysis, applications, and international standard conversions. Big issue is between, as we spoke before, is GAAP versus IFRS. So if you are an analyst, you are sitting in US and you are analyzing some company of US and the company based in UK. The company based in UK, they are following accounting policies based on IFRS, and in US they are following the GAAPs. The treatment for inventory valuation is different, depreciation is different, so you cannot compare two different treatments and come up with some conclusion. So first of all, we should learn how international standard conversions goes on, which are the important things and how it will be converted. Broadly, we are going to discuss the comparison companies using ratio analysis, common size financial statements. What are the common size financial statements? Financial statements we know: statement of financial position, income statement, cash flows, and disclosures, footnotes. These are all financial statements. When you see the audited financial statements, you will see in the amounts. Common size means that this will be in percentage. And how it will helpful, how it looks, we will discuss today. Charts in financial analysis. When we have information, we can put it generally in Excel and we can make certain kind of graphs. What are those? We will see. Describe the limitation of the ratio analysis. Explain and demonstrate the classification of the financial ratios. Calculate and interpret activity, liquidity, solvency, profitability, and valuation ratios. These are all the types of ratios which generally an analyst should know. What is liquidity ratio? Liquidity is the availability of money, the ability to pay your short-term debts is your liquidity. Solvency is related to your long-term survival. So we check, do you have ability to survive in short run and in the long run. Then profitability, we have to see your business is profitable. You are making money in terms of profitability, or you are losing money in terms of gross profit or net profit. And valuation is about your stock valuations. So these ratios are going to give you the financial health and strength of the company. For example, if you go to a doctor, he will check your blood test, sugar test, blood pressures and all other things. And he will tell you that you are fit or not. Same way, an analyst is going to check your liquidity, gearing, valuations, and then he will be able to give some comments about your financial health and performance of the company. Then we have to see how ratios are related and how to evaluate a company using a combination of different ratios. We have to see the company size, it's small, big, they have more branches, which country they are operating, what is the industry standards. These are all things we have to keep in mind. The application of DuPont analysis. The DuPont analysis is an old analysis and very famous, very effective. What is this? We will discuss today. Calculate and interpret the ratios used in equity analysis, credit analysis, and segment analysis. Describe how the results of common size and the ratio analysis can be used to model and forecast earnings. Now, for applications, evaluate a company's past financial performance and explain how the company's strategy is reflected in the past financial performance. prepare a basic projection of the company's future net income and cash flows. Describe the role of financial statement analysis in assessing the credit quality of a potential debt investments. Discuss the use of financial statement analysis in screening for the potential equity investment. Our all analysis are dependent on financial statements. Financial statements are the basic and starting point to understand the worth of the performance of the company. Then we have to justify appropriate analyst adjustments to a company performance financial statement to facilitate comparison with another company. What adjustment we need to take in consideration before we can compare two companies. Now we will start our discussion. The discussion will start with the common size statements. Common size statements could be a common size income statement, or it can be a common size balance sheet. Generally, when you see a balance sheet, you see a financial statements, they are in figures. And by standards, even US GAAP or its IFRS, we have to make financials in comparison with 2 years, this year and the last year. So if this year is 10 million sales, last year is 12 million sales, this is figure. These financials, the format will remain same, but they will be given as a percentage. I will show you how before I go forward. You can see these are the percentages. Balance sheet will be shown as a percentage of asset, and income statement will be shown as percentage of sales. You will take the figure, divide it with the sales figure, and it will come as a percentage. You will take the cash, divide it with the total assets, it will give you the percentage. So we will study for you. Common size statement, normalized balance sheet and income statement, and allow the analyst to more easily compare performance across firms and for a single firm over time. You can see here, because these are the percentages, so it's very easy to compare. For example, if you have a fixed salary and you have expenses, if you will write like 3,000 this, 4,000 this, 2,000 this, so you will not reach to somewhere. But if you make it a percentage and you come to know your full salary, 40% goes in rent. So you can see, this is a big expense, right? This more convenient. That's why analysts make common size balance sheet and income statement. Vertical common size balance sheet expresses all balance sheet accounts as a percentage of the total assets. Means you take the total assets and divide with individual figures. So it will give you a percentage. A vertical common size income statement express all income statement item as a percentage of sales. You take the sale figure, you divide it with all expenses, because in income statement we have income and expenses. In balance sheet we have assets, liabilities and equity. Now this is common size income statement. You can see revenue is 100%, because every percentage you have to take keeping in view the sales figure, and cost of sale is 59% of the sales. GP is 40% of the sales, and same expenses are this much percentage of the sales. So you can change the sale, you can see the effects more quickly, more easily, right? This is how we have to start thinking now. Financial ratios. These are like blood pressures and other tests. Every financial analyst has specific ratios to test. He has to test that the company is able to pay money, day-to-day expenses. This is liquidity. He has to see that if you have 5-year loan, 10-year loan, 20-year loan, are you able to pay the loans? Because if you will not test all these things, you will not reach to an analysis. How? If suppose you take a personal loan from a bank, 100,000. Now 100,000 is in your account. If I see your bank balance, it's 100,000. Right? Then you are giving me installments out of this 100,000. Every month, second month, third month. Because you have money, you are paying installment out of same money. So means you are paying, bank should be happy you are paying. But in fact, you are paying from the principal that you have. And one day it will finish. So if I only see your bank ratios or your short-term ability to pay, it will be misleading. Because in the long run, you are not able to survive even. So same way, we have to see all this. Activity ratio is how active you are in the business operations. This category includes several ratios also referred to asset utilization or turnover ratios, inventory turnover, receivable turnover, and total assets turnover. How efficiently you are selling inventory, how efficient you are collecting your receivables, how efficiently you are paying your payables. This is all activity ratios. If you are good in your activity, means your day-to-day operational management is effective, and you will link it with the operating cycle concept. What is operating cycle concept? Is when you buy something from your supplier, you have to pay him some amount. But this goods that you bought, it will come to your warehouse. Then you will produce. After production, it will be sold out. Then it will be sold on credit. So money will come after again sometimes. So operating cycle is a cycle which starts from purchase and it finishes when you collect the money from the customers. This is the operating cycle generally, and it should be positive. How positive? Your payable days should be more and your receivable days should be less. So you don't need to invest from your own pocket. You will get the money from customer and you will pay it. Suppose you have to pay him in 100 days and your production, your sale, your collection is 90 days. So you get the money from customer in 90 days and you pay to your supplier after 10 days, means total 100 days. So you don't need to put money from your pocket. You get a credit period from him and you do all your operating cycle and you get money from customer. Out of that money, this money is more than what you bought because you add profit into it, right? So activities ratios, you have to see that how efficient you are in selling stocks, in receivables, payables. Liquidity ratios here refer to the ability to pay cash expenses in short term as they come due. Liquidity is the ability to pay the short term expenses. Suppose you have good car, you have good home, but you don't have money to pay your Diva bill, or you don't have money to fuel, so it's useless for you, right? So generally some kind of mismanagements we observe in the companies like this. They took loan, they bought a machine, this machine, now they don't have salaries to pay. So this kind of mismanagement is most of the cases we can observe in the general market also. So solvency ratios give the analyst information of the financial leverage and ability to meet its long-term obligations. Financial leverage. Leverage is a word shows ability to pay. Financial leverage is cost of fixed debts. Suppose you have a car loan, you have home loan, you have personal loan 5 years. These are your fixed debts that you have to pay. So it will create a leverage for you. And then profitability ratios also provide information on how well the company generates operating profits and net profits from its sales. Valuation ratios are sale per share. You will take the share value, divide with the sales. Earning per share, EPS, that we discussed in the previous lecture. And price to the cash flow per share are example of the ratios used in comparing the relative valuation of companies. You want to see that what is the share value in comparison, say with sales, asset, in terms of any other thing. You can see book value, market value. This we will learn today. Now let's discuss one by one. This is activity ratio. Receivable turnover. What is turnover? How many days we get our receivables. Annual sales divided by average receivables. What is average receivables? Opening receivables plus closing receivables divided by 2. Wherever average word is used means opening plus closing divided by 2. It may be opening receivable, opening payable, average receivable, average stock. If it is average inventory, opening inventory plus closing inventory divided by 2. Days of sale outstanding, 365 divided by this formula, receivable turnovers. So you will see that how many days generally your money gets stuck in with your customer. Inventory turnover, how many times inventory is sold out? It should be more. If it is more, means you are more efficiently using your stock, your sale is good. Cost of goods sold divided by average inventory. And days of inventory on hand, how many days you keep it in your hand before it is sold out? 365 divided by average inventory turnover. These are the ratios which, if you are working in any department in company, which is manufacturing company or a trading company, this should be built-in ratios. It will give clarity and you can create a stress on the sales department. If you are using these ratios, you can tell them that we have blocked money in our stocks and you are not efficient in selling the stock, because turnover means, inventory turnover means how many times you sold the stock. It should be maximum, means the stock should be sold so many times. It will show your efficiency in terms of your operations. Then we have opposite payable turnover, that is purchase divided by average trade receivables. What is average trade receivable is opening payables, or average trade payables is opening trade payables plus closing trade payables divided by 2. Opening would be on the start of the year and closing would be at the end of the year. So if you are given 2 years balance sheet, so data will be available there also. Number of days of payable, 365 divided by payable turnover ratios. Total asset turnover. What is total asset turnover means? How efficiently you are using your fixed assets. Total assets, even fixed assets, current assets and non-current assets. Revenue, you take your income divided with average total assets. What is that? Opening total assets plus closing total assets. Total assets is equal to current assets plus non-current assets, your fixed asset. Fixed asset turnover ratio is, only difference is here we took total assets, here we took only non-current